Welcome back to Investing Talk Podcasts.
Today we're looking at Clear Secure.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Clear Secure. The story here isn't just one of growth, it's more one of accelerating operational momentum. You can really see it in the results from the second half of last year.
That's the key takeaway right out of the gate, isn't it? I mean, looking at the Q4 2024 revenue, they pulled in, $187.2 million. And crucially, they didn't just meet the forecast. They beat the analyst consensus by a solid 4.5%.
Right, but just focusing on that one quarter kind of misses the real trend. If you track the year-over-year revenue growth across 2024, it showed a sequential acceleration.
It just kept picking up steam.
Exactly. They started the year growing 12.1% in Q1, then it went to 14.2%, then 17.6%, and finally topped out at 19.4% growth in Q4.
That kind of sequential increase is a really powerful signal. It tells you the underlying demand is getting stronger. It's not just, a few big one-off contracts. This is systemic improvement.
It is. And when you see acceleration like that, you have to ask, okay, where's the engine? And in this case, it's overwhelmingly in their core product, the Identity Verification and Access Management segment, or IVAM.
Right. That segment is doing all the heavy lifting. It drove, 82% of the total revenue growth for the year?
That's the one. And the numbers inside IVAM itself are just huge. Revenue shot up 56.6% in just 3 quarters.
And that's coming from the enterprise side, I take it?
It is. We saw 31% year-over-year growth in new enterprise contracts. And where are they landing? In really regulated, high-value areas like U.S. healthcare and fintech.
Those are not easy markets to get into. That says a lot about the trust they've built.
It really does. And that leads us perfectly into the margin story. Because when you see this kind of rapid top-line growth, the big question is always, are they just spending a ton to get it?
But the numbers suggest that's not the case at all.
Not even close. The efficiency gains are really impressive, and they seem to be structural. Gross margin expanded in Q4, hitting 71.3%.
Which was up from, 67.1% the year before?
That's right. And this is all thanks to disciplined automation, mainly optimizing their identity matching algorithms.
But there's a detail in there that often gets missed, the strategic infrastructure shift they made.
That's where the real long-term cost advantage is. They moved a big chunk of their core compliance infrastructure over to AWS Nitro Enclaves.
So wait, this wasn't just a basic cloud migration to save a few bucks on hosting?
Not at all. Nitro Enclaves are these hardened computing environments that isolate super sensitive data. And because they could prove this superior security posture, their third-party compliance audit costs actually dropped.
By how much?
By 33%. That's a direct permanent saving that goes straight to the bottom line year after year. It's a structural gain, not a one-time thing.
Okay, that makes the improvement in the operating margin much clearer. It jumped to 22.7% from 15.1% the prior year. So they're growing fast while also making their operations cheaper.
It shows really strong management discipline, and that operational excellence flows right through to the balance sheet.
Which analysts are, I think, correctly calling robust. They ended 2024 with, $542 million in cash?
Against just $110 million in long-term debt. That's a huge net cash position, about $432 million.
They're sitting on a massive war chest. And what's interesting is they're generating so much cash internally anyway.
Exactly. Free cash flow for the full year 2024 was $148.7 million. That's a stunning 64% increase year over year.
A 64% increase in free cash flow. That's what you want to see. The FCF margin expanded to 27.3%.
And management is using that cash. They put $62 million into share repurchases last year, which cut the share count by almost 5%.
Which is a clear signal of confidence. Okay, let's switch gears to the core of the thesis. The competitive advantages, the moat. Why can they do this when others can't?
Well, it's not just one thing. It's a multi-layered network effect that's, frankly, really hard to compete with.
So what's layer one, the foundation of that moat?
Layer one is just extremely high switching costs. Like you said, their API is woven deep into a company's core workflows, KYC, payroll, all of it.
So if a client wants to leave...
It's a nightmare. They have to re-engineer their entire compliance stack and then get it recertified across more than 14 different regulations.
We're talking a year or more of work, right?
We're talking 12 to 18 months of disruptive, high-risk, expensive work. It's just not rational for a major client to do it.
That's powerful. What about the tech itself, the IP?
That's layer two, the regulatory and technological IP. They have 39 active patents in really key areas, Liveness detection, for one.
So proving the user is a real person.
Right, not a photo. And also something called zero-knowledge proof authentication.
Okay, for our listeners, what does zero-knowledge proof mean in simple terms?
Basically, it's a way to prove you have the right credentials without actually revealing the credentials themselves. It makes data breaches pretty much useless because the sensitive info is never actually transmitted.
And the third layer has to be the data, right?
Precisely. The data moat. They've collected a proprietary data set of over 1.2 billion verified identity events.
And that data trains their model.
Constantly,
Hmm.
which gives them an incredible edge in accuracy. It leads to a 42% reduction in false accepts compared to the industry average. For a bank, that's huge.
And you can see that playing out in the market. You look at a competitor like OnFido, they reported, what, 8.7% growth in Q4?
Just 8.7%. Meanwhile, Secure hit 19.4%.
Hmm.
That gap is massive, and it shows the moat is working right now.
Okay, so let's look at the market and the technicals. The chart is now looking, well, it's looking extremely bullish.
It's a classic setup. You've got this beautiful multi-month cup and handle pattern.
A big continuation pattern, and it completed when the stock broke out above that key resistance level of $38.50.
That breakout was on good volume, too. And you also had the golden cross back in late January.
The 50-day moving average crossing above the 200-day. A classic long-term bullish signal.
And we're seeing huge confirmation from institutions. This isn't just retail money. Institutional ownership is up over 81%.
And it's the big names, too. Vanguard, BlackRock, Fidelity. They added over 6.2 million shares combined recently.
Plus, you had the insiders buying earlier this year. The CEO and CFO both bought shares.
So that conviction must be tied to what's coming up. Let's talk about the catalysts.
The calendar is packed. It started recently with that AWS IAM Identity Center integration.
Why is that so powerful?
It's enormous. Millions of AWS enterprise customers use that to manage user access. By integrating directly, Secure becomes the default, easy choice for them. It widens their sales funnel overnight.
And then looking at May and June, there are 3 big events.
First, Q1 earnings. The street is looking for $195.2 million in revenue, which would be over 24% year-over-year growth. So continued acceleration.
Then there's an investor day in mid-May.
Right, where they're expected to launch their identity cloud platform. The guidance suggests it could hit over $100 million in recurring revenue in the first year.
A major new product launch.
And then in June, they're presenting at the NIST Cybersecurity Workshop. Any kind of nod from NIST could be a huge boost for them in government and regulated industries.
Okay, so we have great financials, a huge moat, and a loaded catalyst calendar. So let's pause. We have to look at the other side, the counter-narrative.
Absolutely. That's the critical piece. Some reports suggest the bull case is kind of thin, claiming they're a minimal forward catalyst.
Which seems to ignore what we just talked about.
It does. And then there's the most immediate quantifiable risk, concentration risk. They're really dependent on 2 sectors. 58% of their 2024 revenue came from U.S. healthcare and fintech.
So any slowdown there could hit them hard. And that brings up the valuation.
Yeah, the PE multiple is up there. It's trading at a premium compared to its peers.
So how do you justify paying that? Doesn't that make the stock really sensitive to any disappointment?
It does. Valuation is a real risk. But you have to put it in context. The high PE is supported by those high gross margins. And, more importantly, the incredible free cash flow. Their price to FCF ratio is around 29.5 times, which is actually below the average for a lot of high-growth software companies.
And what about that weird market perception? Some sources claim 0 analyst coverage and a lack of product innovation. It's directly contradicted by the AWS deal and the upcoming investor day.
That's where the opportunity might be, that divergence. The idea of 0 analyst coverage is just plain wrong if major banks are upgrading the stock. It seems like the market's perception hasn't fully caught up to reality.
And circling back to that concentration risk, how are they dealing with that?
Through international expansion. Their global revenue is a smaller piece of the pie right now, but it's growing much faster, at 34% year over year. They're moving to Europe, getting GDPR compliant, and running pilots in Asia, including one with the Bank of Japan. So they are actively working on it.
So for you, the investor, it really comes down to these 2 conflicting paths, doesn't it?
It does. The whole thing revolves around a core conflict. Does the strong financial acceleration and that deep proprietary data moat outweigh this market perception of inactivity and its dependency on these big May and June events?
The bull case really hinges on them executing over the next couple of months and validating that strong full-year forecast.
Right. But the bear case is that if those catalysts disappoint, that premium valuation could see a painful correction. It's a classic situation where the fundamentals in the chart point up, but market attention is lagging or, just split.
That wraps up our analysis of Clear Secure. We appreciate you tuning in, and make sure to subscribe for more in-depth analyses into the companies shaping the market.